Today we're diving into the world's largest healthcare conglomerate, Johnson & Johnson's second quarter results, and giving investors everything they need to know about the company. This is your market checkup. Now, Max, Johnson & Johnson reported just strong second quarter results, but before we jump into that, let's give investors a better look at the breadth of Johnson & Johnson's operations.
Yeah, it's a huge conglomerate, and they operate in three main segments, so we can take a quick look at our pie chart here. Medical devices and pharmaceuticals are about the same in terms of revenue, both around 40%. Consumer health brings in about 20%.
Mm-hmm. And as I mentioned, it was a really strong quarter. Revenue grew 8.5% for the company, almost up to $18 billion. It was $17.9 billion. And earnings per share just crushed analyst estimates. It came out at $1.48 per share. Estimates were for $1.39, so they really trumped what the street was expecting. They also raised guidance, which everyone loves to see.
Yeah, and that's actually something we haven't seen a lot in the pharma.
From a lot of the other pharma companies. We've even seen some lower guidance going into the back half of the year. But J&J said, nope, we're raising it. They raised the bottom end of guidance by 5 cents and then added 2 cents to the top end. So that was really good news all around. What did you see as far as what worked for the quarter and for the different segments, how they broke out?
Yeah, I always start kind of high level just to see how sales came in. So medical devices were up almost 10%. Pharma is really the standout unit here. Sales up almost 12%. And consumer pitched in with about 1.1% growth.
Yeah, I would say the divisional performance ranged from good for medical devices, amazing for pharmaceuticals, and really just passing for consumer. And I would, if they were a student, I would say I would hope consumer took the quarter pass-fail, because I don't know if they would have liked the letter grade I would have given them. Right. Something else that stood out to me was Johnson & Johnson sold off their remaining stake in Irish pharmaceutical company Elan. They had a partnership for an Alzheimer's drug, bapineuzumab. It failed both of its phase 3 trials, but Johnson & Johnson still did net $1.3 billion by liquidating the stake, which even for a company the size of Johnson & Johnson, that is a nice little boost to the quarter. But let's take a look. We'll put it in perspective a little bit. Abbott Labs is often referred to as a mini J&J. How would you say Johnson & Johnson, the original J&J, matches up to its smaller doppelganger?
Well, Abbott is a little bit more different from J&J these days because they spun off their pharmaceutical division.
Into AbbVie, yeah.
Into AbbVie, right. And that happened at the start of this year. And as we were talking about before, J&J's pharma division has been doing a great job. We were talking a little bit before the show. That unit has been kind of dormant at the company for a while, but they've just started to grow, and they have an amazing pipeline, a lot of new drugs on the market. So that kind of fast-growing segment isn't really there at Abbott. They have medical devices, nutrition, slower-growing divisions. And actually, if you look on a PE basis, the forward PE for Abbott is about 17. J&J is in line with that, slightly lower according to Cap IQ. So based on the growth that investors have been getting with J&J, I would say that would be my preferred pick of the two.
Yeah, I think that would be my pick as well. If you take away the pharmaceutical company from Johnson & Johnson, it becomes a lot less interesting to me. I think that's kind of where the upside kicker is, as we're seeing a difficult environment in medical devices, and consumer goods is just, it's not a fast-growing division, right? It's not going to win any growth race. So pharmaceuticals is exciting. Beyond that, you just really have a stable dividend-paying business, which if that's what you're looking for, it makes sense as an investment. But if you're asking me which is more interesting to me between Johnson & Johnson and Abbott, I think I have to say Johnson & Johnson hands down. So let's move to Johnson & Johnson's biggest segment by proportion. That's medical devices and diagnostics. It makes up about 40% of the company's business. Now, growth was 10% for the segment, and it's been a tough environment overall. Utilization has been down. That growth does come after a really soft first quarter, so it does provide a little nice sequential comparison. But
David, if you look at their orthopedic sales, they jumped 46%, actually more than 46%.
Well, that is the headline number, but sometimes you have to peel that back, and that growth comes from the Synthes acquisition. Without that, orthopedics grew, what, about 3%?
3% on an operational basis.
Although I actually did, I found that a bit of a bright spot, just considering all the metal-on-metal hip replacement bad news they got, the recalls, to show that it didn't damage their brand overall, that they are still growing. I think that is good news. But that's also not to knock the Synthes acquisition, right? That was the point of buying it, to not grow organically, but to grow through acquisition. And when you're a large company like Johnson & Johnson, that's oftentimes how you have to grow, because a couple incremental sales here doesn't really move the needle. You have to take over large companies, and Synthes certainly was a large company, and now it's a big part of Johnson & Johnson.
Right. Actually, David, so when I was perusing the rest of the report, I noticed that diabetes care was down. It's not its biggest subdivision in medical devices and diagnostics, but sales dropped about 12.5% due to pricing pressure. And they also had a decline in their diagnostics business. That was due to divestiture, but diagnostics is kind of an interesting story at J&J.
Well, it was down maybe because of a divestiture, but it looks like the whole segment might be a divestiture, and we might be calling this just medical devices in the near future, not medical devices and diagnostics. It was raised on the call. Management said they were looking into getting rid of their entire diagnostics business. And an analyst was asking about the time frame for that. Management responded with, they're still in the early stages, so it would be in a 12 to 24 month time frame. So I don't think that's something investors need to really keep their eyes open for in the immediate future. But when it does happen, I do think that'll be a bonus. I think it'll unlock some value. I feel like Johnson & Johnson as a conglomerate is trading for less than the individual parts are worth. Breaking apart, and we've seen this approach a little bit. Pfizer's been ripping itself apart to try to, unlock the value of their pharmaceutical business.
They spun off their animal health unit. They sold off their nutrition unit. We've seen the same with Abbott, which we were just talking about. They spun off their pharma division into AbbVie. And historically, if you look at J&J, they haven't been very good about unlocking value just because they're so big. So I think now might be the time to start picking apart some of these slower growing divisions.
Yep, and I think when you add a big business like Synthes, it makes you take a look at, okay, what is really our core here, and what's secondary, what's slower growing, what can we sell off, monetize, and then use that money for better use, even if it's just buying back shares or upping the dividend, which I'm sure every investor would appreciate.
Or R&D in their pharmaceutical division, which we're going to talk about now.
Yes, exactly. Their pharmaceutical division, neck and neck with medical devices, 39% of the business, but it is easily the most exciting part of the business. It is not facing nearly the tough environment medical devices are facing. It had a really impressive quarter, 12% growth. It looks like it's trending for double-digit growth for the year. And this is really on the back of a wave of products that were launched since 2011. They totaled $4 billion, just these products, $4.4 billion in 2012 sales. So a lot of new products are pushing the company forward.
And actually, the one I was looking most closely at was Invokana. That's a diabetes drug that was approved recently, and it's the first in its class. It's called an SGLT2 inhibitor. I was kind of disappointed that they didn't break out the sales, but it's very early in the drug launch. So I'll probably have to wait until next quarter to see how that's.
Yep, you're going to have to be patient.
Yeah. Excuse me. I was also looking at Remicade sales. Remicade sales were up almost 10%, which is amazing because it competes against the best-selling drug in the world, Humira, made by AbbVie. Yep,
and it just shows really the breadth of the rheumatoid arthritis market and why all the big pharmas are gunning after it. Combined, Humira does what, $9.6 billion in sales, Remicade 6.1. So we're talking about a $15 billion sales between the two biggest competitors in this market, and it's massive.
But actually, there are other players. You have Enbrel.
Absolutely.
From Pfizer.
Absolutely. It's really, there's more than enough to go around, seemingly. But the question becomes, Humira, part of the reason it was spun off into AbbVie is because its patent protection does run out in a couple years. Now, we don't know if there will be a biologic biosimilar approved, but if there is a cheap alternative, now that they're different drugs, obviously that's injected, Remicade is infused, but if there's a cheap alternative, will that hurt Remicade sales by extension?
Right, that's a great question. I think the FDA still has to sort out its biosimilar legislation so that companies know what they have to do to get approval there. But biosimilars and follow-on biologics, that's something I'm watching pretty closely. But David, let's pivot to one last thing in the pharma division, and that's the prostate cancer drug Zytiga.
Yeah, Zytiga was its fastest growing drug for the quarter. It was up 70%. It's now its third best-selling drug. It got an expanded indication. It was used post-chemo. Now it's moved into the pre-chemo space, where it competes with Dendreon's Prevenge, and competes rather successfully. Dendreon saw community oncologists drop for the quarter, and they said they didn't quite, I think, and I'm paraphrasing here, really appreciate the threat that Zytiga was bringing, and it's been just a great drug for Johnson & Johnson. The question is, will it keep going? They have competition coming from Medivation's Xtandi. Xtandi is already on the market, but it's in a second-line indication, which means it would have to be used after Zytiga. But Medivation is trying to move into that first-line label, and so at that point, a lot of doctors and experts believe that Xtandi is the better product to Johnson & Johnson. I know J&J went out and made an acquisition to try to bolster their prostate cancer franchise. But the question is, will that impact negatively Zytiga sales, which right now are just rocketing up? And I think that brings to a bigger question. We talked about generic Humira. We talked about potential competition for Zytiga, which are two very important drugs. How long can J&J keep these pharma good times rolling? Double-digit growth is really hard to sustain. It was a sleepy division for years, so it is great to see it come alive. You also take a look at Incivo, which is Vertex's Incivec that's sold in Europe.
And that's to treat hepatitis C.
That's to treat hepatitis C, and there's competition coming out by Gilead, Sofosbuvir. It would have to get approved, but potentially that could really decimate Incivo sales. Of course, Johnson & Johnson has a drug in its pipeline, Simipravir, which could also decimate Incivo sales.
Right, so I think that also illustrates the depth of J&J's pipeline, and how aggressive they are about really building out a sustainable R&D structure there.
I think so too, and Ibrutinib, a lot of people are excited about as well. I mean, that could be a multi-billion-dollar blockbuster.
Right, their collaborator Pharmaceutical filed for FDA approval, I think, a month ago.
Yeah, and that's something J&J investors really should be keeping their eyes out, because that could be one of its best-selling products. And I think that does speak to, that sort of answers the question. Yes, they're it may not be smooth selling for all of their approved drugs, but their pipeline, not only has it had a lot of recent successes, it looks like it has more successes to come.
Yep,
so from there, let's move to the final segment of Johnson & Johnson Consumer. Now, some would say this is the sleepiest, most boring segment, but please do not click the back button on your browser.
Well, actually, so it may not be the division that investors are looking at, but it's certainly the division that you and I and probably our viewers are most familiar with, right?
It's how you interact with the company.
Right, so they have brands, Neutrogena, Motrin, Listerine, Tylenol, baby powder, Band-Aids.
Yeah.
So a wide variety of products that I'm sure a few of us have in our medicine cabinet.
Yeah, you open your medicine cabinet, I can almost guarantee you there is a Johnson & Johnson product in there.
Yeah, I would agree. We said at the top of the show that sales were up only about 1%. What really drove sales?
Well, I saw that it was up 1%, but the problem was it was 3% last quarter, so I'm not really thrilled with its quarterly growth. Over the counter, though, turned in a good performance.
Yeah, it was a major driver, up 7.9% this quarter, and that has a lot to do with Tylenol. So they widened their distribution this quarter compared to the same quarter a year ago.
Well, and they've had some recall issues.
Yeah, that's exactly what brought them down last year. And actually, David, just to close up the show, one thing I find surprising is how Tylenol continues to be a leader in this space when there are a lot of generic competitors available over the counter.
Yeah, and
it baffles me.
And the funny thing is, we both know there's no difference, but I still buy name brand stuff.
I have to be honest, sometimes I do too, just out of habit. I think it goes to prove that marketing does work.
And I think that could potentially actually be an international strength, because they have counterfeit issues in emerging markets, and you can still charge more for name brand products.
Right.
And so, that's something investors need to watch. But thank you for watching Market Checkup on Johnson & Johnson. And I think we'll probably be diving deeper into the pharmaceutical pipeline as well in the coming weeks. So
yeah, there's lots to discuss there.
Stay tuned for that as well. For Max Macaluso, I'm David Williamson. Thanks for watching, and Fool on.